Hello, I'm Michelle Suskauer, and welcome back to Insure Wealth. Our program today is about something that so many people know very little about, but something which can let you participate in the upside of the market with absolutely no downside risk: annuities. I know you're saying that it's too good to be true. Well, here's the man with years of personal experience understanding every aspect of annuities, and he wants to share them with you. Howard Kaye. Welcome, Howard.
Thanks, Michelle. It's great to be here and to be able to give you, not a pitch, I'm not an investment advisor, but the benefit of almost 30 years of my own experience in understanding the pros and the cons, the risks and the rewards of these annuity programs. And this is really what I'd like to share with the viewers today.
Well, okay, Howard, that's great, but the first question I have is, what's an annuity?
Well, I think most people do understand an annuity. It's really just a stream of payments, a stream of income over a certain period of time. But what's nice about it is that you can customize what that period of time really is. But that, in essence, is what an annuity payout is.
Right, and there are different types of annuities?
Yes, in the marketplace, there's three main types. We call them the fixed annuities, variable annuities, and fixed indexed annuities.
Well, I'm sure that there are good things and bad things. There's pluses and minuses of each one. So let's just break them down. Let's talk about, I guess, the fixed annuity.
Certainly. The fixed annuity is really something that's comparable to a CD, certificate of deposit, right, a money market account, a treasury bill. This falls into what we would call the fixed asset base, okay, where somebody wants to put money away but really doesn't want to take any risk. Now, does that mean there's no risk with an annuity? Well, virtually there really isn't, other than the strength of the insurance company that you're purchasing. But other than that, the insurance company says we're going to pay you a stated amount of interest on the money, and that's what you receive. Like I said, a bank or a treasury or anything else that fits in that category.
So is this sort of low risk, sort of low reward type of situation?
Absolutely.
Okay, so
that's your fixed base.
And then there's the variable annuity.
Now,
Tell me about that.
The variable annuity really is for somebody that enjoys taking risk, although they don't see it as risk. And these are people that like to play the stock market, or they're in mutual funds or things of that nature.
I'm sure we both know people who like to do that.
Absolutely. And while I'm not here to discuss whether that's good or bad, whatever people like to, where they like to put their money, that's up to them. But for those that are taking that route of utilizing the stock market for their returns, the variable annuity allows those people to buy those same mutual funds that they would be buying within the annuity. Okay. So there are certain benefits that are associated with it where the money can grow on a tax-deferred basis. But just as much as they can make in that annuity, they can also lose if the market goes down. So that would be a very aggressive approach, right, and one that we don't get involved with because, again, I'm looking for one thing in particular with everything that we discuss on our show, Insure Wealth, and that is safety, safety, and safety. They say in real estate it's right, location, location, location.
That's right, safety.
This is all about safety and preservation and creating for family and for charity.
Well, let's talk about safety and the third type, the fixed index annuity. And I understand that this is the fastest growing type of annuity. So why is it so popular, and is there that safety factor with it?
Well, absolutely. I like to classify the fixed indexed annuity as a hybrid, okay? So you've got the elements of the safety, of the guarantees, along with the upside potential of the market. Now, why is this? Because in a fixed indexed annuity, the insurance company does offer you a fixed account. Maybe it's paying 2%. It's very little. But they also offer you various choices where you might elect to be in the S&P 500 or maybe some global fund. Now, what's happening is you're not actually putting your money into the S&P 500 or a global fund. You're using it as a measuring stick, or I should say the insurance company is using it as a measuring stick to determine what amount of interest you'll earn for that year. So as an example, if the S&P 500 was up 15% for the year, are you going to make 15%? No.
No.
What the insurance company will do is they'll say, we'll give you a participation rate or a cap rate. Now, what does that mean? They might say, we'll allow you to participate in 30% of the S&P 500. Well, if the S&P made 15% and you get 30%, I guess that's 4.5% you'd make for the year. Or if they said, we will give you 100% participation in that interest return, but we are giving you a cap. Our cap is 5%. So if the S&P makes 15%, you can only make 5.
You're done, right, at 5.
But what is the trade-off for that? Because let's face it, in today's climate, people cannot go out and make 5% on their money or 4.5% on their money without some type of risk associated with it.
Right.
People, it's funny, I speak to a lot of different people and I hear them talk to me about municipal bonds, for example. And oh yes, we get 5%. And I said, how are you getting 5%? They forget to tell me that they paid a premium for the bonds or the bonds go out 30 years or whatever the case may be. Again, I'm not here to discuss whether that's good or bad. I am not an investment advisor, but I can use logic and common sense. So with the fixed indexed annuity, while I am capped at some number or I'm limited by the participation rate, what's the positive part if the market goes down? If you have money in a mutual fund or in the stock market and it goes down 30%, what did you lose? 30%.
Whole lot.
Right?
Yes.
But if I told you in the annuity, if the S&P goes down 30%, all that happens to you is you get 0%. You don't lose.
I like that.
That's a nice trade-off.
Absolutely. Absolutely.
So this fixed indexed annuity gives a person the ability to participate in the ups of the market without participating in the downside of the market.
I mean, the fixed annuity sounds like it's pretty safe. And you were saying safety, safety, safety. I mean, that it's giving me some comfort. So are there any other examples that you have?
Well, certainly. In other words, when we talk about safety, again, I want to talk about insurance company risk, which there's a question of safety there. You know, people are concerned about the safety of the life insurance industry, the life insurance companies. And quite honestly, I've been in this business for quite a long time now, almost 30 years. Originally, our company started 50 years ago. And during that time, I have seen changes in the insurance industry with respect to insurance companies, but never an insurance company going down to the detriment of the insured. All death benefits have been paid out.
Why do you think people are scared about that?
Well,
that the insurance company is going to go under and they're going to lose everything.
They've seen big companies, brokerage firms, different banks go under, and people get concerned. But the insurance industry is such a highly regulated industry that, and there are safety provisions put in place. For example, depending upon the state, you can have up to $300,000 of an annuity protected by the state guarantee fund. So there are extra measures above and beyond the insurance company's strength that protects the consumer. Some states there are 100,000. There are a couple of states within the country that are 500,000.
Wow.
So again, it depends on that. Number two, the insurance companies, while you have seen other companies have issues, in the insurance industry it's completely different. If a life insurance company has a financial issue, the commissioner in the state with the insurance company is domiciled in really looks to find a purchaser of this company or the assets of that company.
I mean, it sounds like the consumer really is better protected in this type of
the consumer is very well protected within the insurance company. So if we get off of the insurance company risk, then the question becomes safety, safety, safety. Well, I like playing the market, but I don't want the risk anymore.
Right.
And depending upon who you speak with, if it's an older person, they'll tell you, I play the market because it's fun. I don't need the money. If I make an extra few $100,000 or an extra $1 million, it doesn't mean anything to me. But if I lose that money, it means the world, because I can no longer create income off of the principal I lost.
So people like the high reward but no risk.
Right.
Okay.
So
sure.
that's what the fixed indexed annuity does. Now, every year, the insurance company can change the participation or the cap rate. So therefore, if interest rates go up, you'll see those cap rates or the participation rates go up so people can make more. But the bottom line is you can't lose your principal. Right. There is no chance of losing principal.
That's significant. That is significant. Now, I've heard of something called a 1035 exchange in relation to fixed annuities. What is that? Is that something that we need to be concerned about?
Well, it's something that is a positive. Many years ago, when people started buying annuities, prior to the fixed indexed annuities being in the marketplace, they were the regular fixed annuities. So these were a stated interest rate for a period of time. People found that when they were younger, they would buy an annuity with the thought that they would utilize that money during their retirement one day. But they've come to find that they don't need the money during retirement. They've got other assets to take from. So they don't want to take money out, because if they do, there's income taxes.
There's a penalty.
Well, there's a surrender charge penalty for a number of years, typically 10 years with an annuity.
Okay.
But I'm talking about whether it's during or after that period. If they want to take income, which they can, they have to pay income tax. So the people that don't need the income says, well, you know what, we'll just let the money sit. Let it accumulate. But let's say their annuity is not performing well anymore. Or let's say there's newer products out there from different companies.
So what do they do?
What do they do? Well, just like in real estate, in annuities or in life insurance, we have what's called a 1035 tax-free exchange. I think in real estate it's a 1031 tax-free exchange. So what this means is I can transfer the money from one company to another, as long as there's the same annuitant or same policyholder of a life insurance policy, and have no taxation on that money. So it enables people that were in an annuity that was not performing well, or it's an old, antiquated annuity, they want to get into a new one, they can utilize this 1035.
So it doesn't sound like there's a drawback for that.
No, not at all.
No,
it gives people the freedom to be able to move that money.
Now, what you're talking about here today is something that I think could give people some real peace of mind as far as their family's financial circumstances way into the future.
Well, let's talk about who this is right for, okay? For the younger person, they like a more aggressive approach. They're 30 or 40 years old, they're putting money away for retirement. They want to make sure that that nest egg is going to be there. And that's what the annuities can do, an indexed annuity. Now, depending upon the annuities, some don't start until you're 50 years old, some you can buy at 25. It just depends on the company. And somebody may be more aggressive in the fund that they choose. Again, when I say aggressive within a fixed indexed annuity, they may choose an option that gives them the ability to make more than what we've discussed, but still, if it goes down, you can't lose.
Okay.
So
I like that.
They've got that safety. So there's some people that are looking for accumulation, then there's others that say, well, no, when I retire, I want income. And I'm concerned that I'll outlive my money. Well, when we add some of these riders to these annuities, they can receive income for the rest of their lives. They can never run out of money. And if they die prematurely and there's any remaining funds, remaining principal within their account, that money will pass on to their family. But the point is they can get income for the rest of their lives.
And that's what people are concerned about. They don't want to run out of money while they're alive.
Absolutely. In fact, I will tell you that this product, the fixed indexed annuity, is probably most prevalent in the senior market. When I say senior market, that's wrong. Really the baby boomer. But let's say from 60 and above.
Okay.
Because it's these people that are saying, I have X amount of money, I want to put it away for, let's say, the next 10 years. And then I want to start taking income. Now they know as an example, if they were to take $100,000 and they were to put it into the bank, they're going to make 1% a year. That's
Right.
$1,000 a year. What does it mean to them?
Right.
In
Nothing.
10 years, it's meaningless. So here's a
It's
way.
sort of like putting it under your mattress. I mean, you're not getting anything out
But
of
within
it.
the fixed indexed annuity, there's two benefits. Number one, they may make 3, 4, 5%, depending upon the company.
Right.
Number two, at the end of 10 years, for those people that are looking for income, I said earlier there's an income rider that can be added to the annuity. What the insurance companies typically do is say, regardless of the performance of any one of these options that you have, whether it's the global fund or an S&P, regardless of that, we will pay for calculating income only, but we will pay to the account 7% a year or 8% a year.
Wow.
Now, if you have that 100,000 that you put in, and 10 years go by and you make 7% a year compounded, that's $200,000. Plus, they give you a little bonus up front too. Now,
I'm liking this. Okay,
now,
this sounds good.
There's $200,000 there. If you made more money the real way within the fund, well, then they'll let you use that. But if you didn't, you know this is your fallback. But again, I said for income only. You can't cancel it and take out the $200,000. It's, again, to measure how are we going to determine your income going forward. Now, you become 70 years old. They may say, now we're going to give you 6% of your $200,000. That will be for the rest of your life. So you know that that $100,000 you put in 10 years earlier, starting 10 years from then, created $12,000 a year for as long as you live.
Wow.
Well, where else can you put the money to guarantee yourself X amount of income for as long as you live? Now, with these programs, I can show somebody, or any insurance company can show somebody, exactly what you're going to get at any given point in time in the future.
Well, that's incredibly comforting because people will know they're getting something.
Absolutely.
They're getting something. They're not, it's not 1%. It's something that they're going to be able to count on.
Absolutely. And for those that say, listen, I like the idea that I can receive income, but the truth of the matter is, I'm never going to take it. I don't need that money. Then we're going to educate them by utilizing an accumulation type approach. So for those folks that don't need the money and they just want to keep it in there and having it just grow and grow, then what happens? Then the same type of options that came with those income riders come with what they call an accumulation rider. So there may be companies that say you can participate in the S&P or whichever one of these funds you want, make up to X percentage, but when you pass away, we will go back and whatever you earned, we're going to add on top of it 2% or 3% or 4% each and every year, compounded, so that now you got extra money. Now, that's the ultimate accumulation. Why? Because you have to die.
Wow.
You don't get that during your lifetime.
Right.
But it's a trade-off. Someone says, I know I don't want income. And let's face it, there are many people that will buy annuities that have no intention of taking income, and they let it sit to accumulate. And you ask, for what reason? Well, I'm not going to spend it, and I want to leave it to my children. I know if I take the money out now, I have to pay income tax. Let it grow tax deferred. When my kids take it, then they'll pay the income tax.
Right.
So if that's the case, why not have as great of an accumulation vehicle as possible?
Oh, absolutely. And not just for your children or any other family members, but maybe for your favorite charitable organization as well.
Absolutely. We've been exposed recently to some new programs that are similar to an annuity, but they're actually life insurance. But it's based on the same type of index we've been talking about. And with those programs, you can actually get out with a guarantee of your principal after 3 years. So without a surrender charge. Now, somebody says, well, wait a minute. If I only get my principal back, I didn't make any interest. Well, I understand that. However, if right now you're making 0.5% or 1% in a money market account, what's the difference?
Right.
You can't lose anything, and you have the ability to actually make good returns within the annuities or within this insurance, and there's a death benefit to boot that's all tax-free. So with all the benefits that you get, it makes sense to utilize that type of approach.
It doesn't sound like there's a downside. It really doesn't, that there's really no downside to this.
Well, again, other than insurance company risk, what downside could exist within something that says you can make, but you absolutely cannot lose? Now, the more riders that are put onto these programs, there are charges for them. It doesn't come out of the rider side. It comes from the actual account value. But in the end, it doesn't affect the person. And why do I say that? Because they're not looking to use the actual money in there. They're looking for the income, or they're looking for the accumulation. There are some companies that offer a life doubler, they call it, or a long-term care rider, meaning that if you're receiving income and during that time you become unable to do 2 of the activities of daily living, 2 out of 6, where normally your long-term care policy would kick in,
right,
they'll double your income for a 5-year period of time.
See, that's incredible, and I'm sure that there are a lot of people who are very interested in hearing that, especially folks who have that long-term care insurance.
Absolutely. So the bottom line is, if people are looking to be able to put money in a position of, number 1, pure safety, number 2, of the potential of the upswings of the market with absolutely no downside risk as far as losing principal, if they want to be able to have income that can be created for the rest of their life without any chance of that stopping, or with the ultimate accumulation, whether that be upon death, whether it be for retirement purposes, whether it's accumulation for a period of time and then income is derived, whatever it may be, that's where the annuities fall into place. And on top of it, they do offer benefits like we just discussed of a long-term care rider or of some combination of return of principal regardless after a short period of time that people like. They know that they can get out if there's another opportunity that comes along. But I will tell you also that this is good for all people. You know, typically within the annuity industry, the averages, the size of annuities that are purchased maybe range between $100,000 to $150,000. But it's a huge industry. I mean, the billions of dollars that go into annuities each year, but it's comprised of a lot of people, huge volume.
Right, because there are people who'll be watching who'll think, well, you know, I haven't accumulated that much wealth and I'm not, you know, a multi-millionaire, but that's not what, this does not exclude them.
Correct. In fact, we're working the reverse now. Many times when we talk about life insurance, I like to talk big numbers. And we're talking about estate planning, and we're talking about taxes, and that really applies to multimillionaires. So people often will say, I don't have that kind of money, but will your programs apply to my particular situation? The answer is, I don't care what you're worth, buy life insurance, because ultimately it benefits your family and charity, whether it's for estate tax, whatever the reason is for. When it comes to annuities, it's more of the smaller monies that go into annuities typically on average. I'm making a very general statement here. And what I'm now saying is to the wealthier people, this is something that you should really consider, because typically people feel, oh, an annuity, it's not a sophisticated product. But what does sophistication mean? It means how much money do I have? How much money can I put away?
But again, as you had discussed, it's also not someone who necessarily needs to take the income. It's about accumulation as well. And you already discussed that.
Absolutely. Accumulation, whether it's for family, whether, like you said, charity, at death. My point, though, is this is for all people. Whether you have $100,000, $50,000, $500,000, $1 million. And as I always say, for estate planning, for people that don't have as much as the very wealthy people, why not take advice from somebody that the wealthy people are discussing this with? You can have the same advice. Now I'm saying to the wealthy people for annuities, if it's good for this group of people, it's good for all groups of people. You either want safety or you don't. You either want guarantees of income or you don't. You either want guarantees of accumulation or you don't. That's what this can provide.
It really applies to everyone, and unfortunately the time has raced by already, and we've been having so much fun, and there's so much more I want to know. I mean, this is so important for all of us who want to protect our money and look forward to a financially worry-free retirement where you can count on a guaranteed income. So once again, Howard, if viewers have specific questions about their specific situations, for more information, 561-417-5883 or InsureWealthTV.com. Well, thank you, Howard, and I look forward to talking with you next week. And we'll see you next week at the same time to share more important facts, figures, and stories that might surprise you. And remember, for more information or questions, 561-417-5883 or InsureWealthTV.com. See you next week.